Welcome to the ProVest Perspective. I'm Gabe Lopez, and with me today is Peyton Hoppus.
What up? Howdy.
Peyton Hoppus, I love. I wish I wish you didn't tell me how to say your name, so I could just keep calling you Hops.
Well, I mean, you can't call me Hops. Some people call me worse.
And welcome everybody to another episode of the ProVest Perspective. Today we're doing something a little We're doing something a little different. We're going to be talking. The title of the show is "Failing to Plan is Planning to Fail." Now, why do you say that, Gabe? Well, as the old saying goes, if you don't plan, you're going to fail. And one of the things with financial advisors, and a lot of people misconstrue this because unfortunately, Peyton, I think you know this. There's a lot of, let's call them other financial professionals, insurance brokers or brokers of sorts that will push products
Yeah.
and call them financial advisors.
They're salesmen. They're product salesmen.
Yeah, salesmen.
Yeah.
Yes, I would love to talk a little bit more about that. But
One day.
the key thing that financial advisors or a good financial advisor should do is planning in regards to everything your finances touch. Because at the end of the day, health with your money is a different type of health, but it still contributes to your overall life satisfaction. Am I not? Like,
Right. Right. Well, I mean, your stress levels go down if you had, 50 grand in your checking account or $500. There's a different level of stress. So sure, that you're not going to live necessarily longer from that, but it lowers the cortisol levels in your brain, right? At
Right.
least in your body. So yeah, if you don't pick a target to aim at, you're going to hit nothing every time. That's like factual. You can go shoot bow and arrow. You can go shoot guns. It's popular in the South where we're at. You're shooting for a certain body weight. You want to lose some weight or muscle mass. You want to gain some muscle. Like, well, if you don't know what you're shooting for, how do you know when you get there or where you're going? So we like to create a simplistic roadmap that is in the form of a written financial plan. Now, that is like the basis of what we enjoy doing as a firm as a whole. We want to plan. We want to help you plan out what you're trying to achieve. That leads to insurance discussions, estate planning discussions. It leads to investment discussions, which is everybody's favorite topic. I mean, let's be honest.
It's starting to shift towards tax discussions.
Right.
Plus, we know how taxes are going right now, so let's plan for taxes to make sure that
I,
that's the biggest bill people are going
I
to pay.
personally love to pay my tax bill so they can send it outside of the country to another country that may or may not have my best interest. I mean, that's my favorite.
And then buy weapons to yourself.
Yes, okay.
A country that you
So clearly, it would be in everybody's best interest to steward your money well, pay as least amount of tax as possible that's legal. And how do you do that in an efficient way? I mean, that's what we're trying to solve for. High achieving professionals, whether you're a doctor, salesman, you're a business owner, you don't want to pay tax or you want to mitigate that as much as possible. Your average person that is working a W 2 job for now and has a little bit of tax bill, like what's the efficient way to manage that? When do we start really hammering that down at what income levels? And so whether you're making 50 grand or 250 grand, the strategy does look similar, but a lot different at the same time. It's all the same concept, but how you apply it looks different. And that really boils down to the investments. Where do you put your money and how do you invest it and what's efficient and what's not?
Right. And you need to, good planning covers a bunch of different aspects. So I want to talk a little bit, and I want your opinion on what kind of, we covered it very briefly there for a second. You discussed insurance, you discussed estate planning, you discussed
Yep.
taxes. That covers a whole different field of different facets that money touches.
Sure.
So talk to me a little bit about the most impactful discussions people will have in financial planning. First of all, let's just give a very baseline overview of what a financial plan,
Yeah.
because
Let's define it.
you find a financial plan, talk a little bit about what might John Doe and Jane Doe might
Yeah.
put a financial plan if they come to us.
That's right. So your average folks are busy. Your average folks have some kids, or maybe they have some grandkids at this point, and their priorities have shifted. Your average folks are enjoying vacation. They want to be able to go eat a nice steak every now and again at a steakhouse. They want to enjoy paying for their bills without stress. And it gets harder with inflation. It gets harder with obviously a lot of the income and expenses that you experience in life. But the base form of a financial plan, doesn't matter what your desires are and everything I just described, is you basically take the income minus the expenses. We determine either what's left over or where we're overspending, and then we write a plan to attack whatever problems we come up with, right? So maybe you got that credit card debt, and I've got folks that have killed it and made hundreds of thousands of dollars to still have some credit card debt. Because what happens? They get used to making that money. They take their eye off the ball. They overspend. It goes on a credit card somewhere. So nobody's immune to it. But when we plan, a basic financial plan is a written financial plan. Okay, we use a software system to do this, where we take income and expenses and we extrapolate out what that result is. So as advisors, when we do planning, in the financial plan, that's the base level of it. It's what I just described. But in the planning for us, I don't tell you if you should or shouldn't buy a pair of Under Armour pants that you can wear to work. That's not my goal. My goal is not to tell you to buy Starbucks or not buy Starbucks. However,
Do not take my pink drink away from me.
well, you can have your fun drink, you big grown man, with your pink drink. But listen, if you are spending your money in the way that's stewarding it, you're going to have success. My job is to tell you what that looks like. My job, if you hire me, is to tell you what your money will look like because you're spending it on your pink drink or your Under Armour pair of work pants. I just bought some, so that's why I bring it up. And I chose to spend my money there. And so if you do that enough consistently, I will basically tell you what your cause and effect are of how you spend money. That's it. So a financial plan is uncovering that and explaining that. But then beyond a financial plan, when we write it out beyond what the income and expenses are, we then start getting into milestone planning. Okay, milestone planning is what milestone do you want to be at 50, whether it's numerical or it's something you want to do in life, 40, 35, kids. And so people who are in their mid-20s to mid-30s are having kids, buying homes, buying cars. They are expending the most amount of money to get started as they possibly can. That's just life. That's the family formation period. And they'll spend the most amount of money until they're about 47 on average, depending on when they're having kids. And so in those years, how do we plan around that? Mm-hmm. So a financial plan is writing out what your income and expenses are going to be year over year or through those years. And it can be for retirement planning. Obviously, that's what you're trying to do, but you're trying to get through milestones. And then you're also looking, how do I take care of mom and dad, which is me in this example, and take care of my kids, but I got to retire. So I can't just plan to pay for their college in total and then sacrifice my own future. So how do we balance that, right? So planning is literally putting a dollar in a position that will be successful and solve another problem or answer or help you achieve a milestone in the future. It could be 5 years, could be 20 years down the road, and we can extrapolate out what that looks like.
Yeah, and some of those, you touched on this a little bit, and I want to circle back on that, because talking about your goals, the client's goals,
yep.
Whoever's listening to this, your goals and making a plan to achieve those is at the end of the day what we're trying to aim for. As much as I love to... And we have a couple of clients, walk in and say, I want to have $5 million by the year 2030. Well, that's great. We can definitely see if we can write something out to make that happen. But I want to get more granular about why you're here. Do you like woodworking? Do you want to open your own woodworking shop? Do you want to go to every NASCAR race in the next 5 years and never miss a beat? Do you want to go to every MLB stadium? Well, let's talk a little bit about what your hobbies are, and let's make sure that we can plan out to get that. Because at the end of the day, money is money. Right. That will always be around, but from what my experience is, as my limited time on this earth, experiences are going to be what sticks to you.
Right.
You don't take, unlike the pharaohs of old, we don't take any money into the afterlife. So dying with that, let's plan to make sure that you enjoy your time with the assets you've accumulated and the hard work that you made. That's what the whole goal with financial planning is.
That's right. I mean, there's a piece of this that it's unique to every person, and we at ProVest are wanting to be as customized as we can to your situation within reason, right? Like some things are just not obtainable right now, but we can customize a financial plan to show you. And here's an example to show you what you can achieve. A client of mine said, I want to buy a beach house for my family, so I want to buy a condo down in Florida. I've got a motorcycle. I've got a nice Jeep. This guy was killing it, doing well for himself. Was a single Pringle at this time. He's since been married. It's not his priorities have changed. But at the time, we said, okay, income and expenses. We're guesstimating on how much you're going to spend on certain things like the beach house. He said, but I also would like to have a Corvette one day. And so, I don't know, 10 years down the road. I'm in my 30s. Let's do it when I'm 45. Okay, cool. But when do you want the beach house? He was like, well, I mean, I don't know, probably my 40s. Like I'm thinking all this. I'm trying to just formalize it. I don't know. So I said, okay, I'll tell you what. We know the numbers. We know what we're going to do for each of these purchases. Let's lay it out in success. So without either, your success rate is, and we extrapolated it out, 94%. Okay, great. 94% of the time, if I ran your life 1,000 times, you're going to be successful. And then we went into, and then of course you're investing, and that extrapolates out all the investment pieces, debt payments, all the things. Mm-hmm. But if you want the beach house or you want the condo with your parents, and we do the math, and you have a little bit of income off of it, that's okay. But if we put that in and the Corvette, it goes down to like 80% success rate. However, if we put the Corvette after the beach house, okay, assuming we stall that out another 5 years, just making up a number so we could see how it would work, the success rate was 86%. So it went up. So we can push and pull what your milestones are, what your goals are, and then be able to show you what that can do for your financial life. Again, a lot of assumptions 10 or 15 years from now, but at least it gives you a way to make decisions. And we just do that on a shorter term basis most of the time, and we want it to be catered to you. Because it doesn't matter if I want $10 million and you want $2 million. Those are big numbers, but your $2 million gets you retired today. My $10 million gets me retired in 30 years. So we're chasing two different numbers for two different reasons. And those may not be real numbers, but it's just an example that just because that's what one person wants doesn't mean necessarily that's what everyone wants. And everybody has a different desire and a different goal. And so one thing we're going to talk about in the coming weeks is going to be 4 different ways to really retire. And I'm hitting on it right now because certain people want to work longer and shorter and harder to get to a certain age to retire, or work a little less for a little longer, and they can work longer in general all the way to their 70, and they're okay with that because they don't mind to work longer. They just don't want to work 60-hour weeks to do it. They want to work 35, 30, 38, 42-hour weeks, all the way till they're 70, and they're okay with that.
And some people want to take a couple months out of every year.
Yeah, sabbatical or something.
Sabbatical,
yeah. So we're going to talk about that in the coming weeks, but that is just a few areas of how we help people. We want to solve a tax problem. We want to solve a planning problem. How do we plan for the kids? How much money should I have in a 529 account versus a brokerage account for my kids? What's possible? What's not? Those are when you start giving people the aha moments and answers, that's more enjoyable than telling them, hey, you crossed $1 million threshold. That's fun.
Yeah.
But if they feel more comfortable about what they're doing with their finances, that's a win. It's not just the dollar amount on the screen. It's actually feeling comfortable in your own skin and your own finances.
100%. Well, I don't think I could have said it better, but
well, you can try.
I can definitely try.
You try.
Well, we talked a little bit earlier about what financial planning is, what the benefits are, what that might do for somebody. Let's get a little granular. Let's talk about the 3 bucket strategy. I've heard this a lot, especially coming into my career. So for people who don't know what the 3 bucket strategy is, how would you extrapolate that and explain that for people real quick who have never heard of it?
Yep. So coming off the financial planning topic we had the last session ago before we took the break, talking about where to put money. We're talking about how to achieve things in life. We're pretty vague on all that. We left it vague for a reason. Because we want people just to think and dream. When we get into, I'm actually going to take my $1,000 a month and put it somewhere. Okay. You have the 401k bucket that most everybody, this isn't the bucket strategy just now, but you have the bucket of every 401k or something at work. And then you have a Roth account. Everybody's heard of a Roth. You have a brokerage account. Some people call them Robinhood accounts because they just know Robinhood lets me open an account and invest. It's a brokerage account. That's just so everybody knows that's what I'm talking about. But when it comes to a 3 bucket strategy, there's 2 things to keep in mind. There is a pre-taxed amount of money you can put away, and there's a post-tax amount of money, which is pretty much unlimited, that you can put away. That is the tax buckets. So just starting there, 2 real buckets. You either put money away before tax or you put money away after you've paid tax. And that's how you create a layering of this bucket strategy. Now, a 3 bucket strategy from what I'm describing is where do we put money and what is it solving? Well, there's 3 buckets that are conservative, moderate, and aggressive in the stance of how they represent your financial picture. So the aggressive bucket, let's start there, easy peasy, is money that you're going to put into the stock market. Now, in the scale of investing, you have conservative, moderate, and aggressive approaches in the stock market. For our purposes, I'm going to talk about what money is solving for you in a conservative, moderate, and aggressive stance. Okay, so it's not the same allocation. But when you're aggressive, meaning you're putting money to work aggressively every month, okay, that's the aggressive bucket. That's what I consider the aggressive bucket. Within that aggressive bucket, how you invest it matters as well. And that can be in a 401k, and a brokerage account, okay? The moderate bucket, I describe it as the ability for you to put money into something that can grow or has a potential to grow, or it could be paying off debt. So this is how I view this. It's a little different than maybe what you've heard.
Yeah,
but
what I was going to say, what I've heard was the tax, the 3 bucket strategy. You got the tax deferred, you got the tax free, and then you got the taxable buckets.
So there's
depending on where,
probably like 9 buckets because you can break all this down into that, right?
Right.
So maybe we'll do that. We'll break it down further. So the first bucket's aggressive, put money to work. I'm aggressively trying to grow. Even if I'm 55, going to retire, I'm still doing some version of that. The moderate bucket is a more moderate approach to getting financial freedom, and that is creating cash flow expansion, and that is paying off debt. Okay, or that is putting yourself in a position where we're maybe putting money towards the house a little bit, paying off the car heavily, and student loans. I mean, that it is aggressive because you're trying to get out, but I would tell you pay off things in a moderate stance because it's better to be consistent in your debt payments than to try to go really hard and aggressive and get burnt out early, because you can pay on a car for 5 years or you can pay on a car for 2 years and you don't see any results in your cash flow. So it's more of a moderate stance. Then the conservative bucket is where you put money into, so it's a cash flow breakdown, and into, it could be CDs or it could be savings, it could be your checking account, but somewhere where you can get to that money later. You're saving up for a purpose, or you're saving up money into a specific bucket for a reason. And so that's cash flow. Let's call it the cash flow bucket of allocation.
Okay.
We go beyond that, and then we kind of go back to that tax question or conversation where we have a tax bucket, and that's where we put money in an aggressive, moderate, and conservative stance to grow. And that could be investing the money in a sense that you're putting it in your 401k to grow aggressively. You could be putting it into a post-tax bucket of a brokerage account. You could be putting it in an account that has bonds in it, and that's conservative. And so how you put that money in there and what it serves for you is another piece of it. So cash flow it into aggressive, moderate, and conservative buckets to serve a purpose, kind of emergency funds, paying off debt, aggressively growing and trying to grow the business or grow my investment account. And then the second layer beyond that is, okay, well, once I put it in said bucket for a purpose, where does it go in investment world? And that is when you get into the stocks and bonds, mutual funds, ETFs. Okay. So so we could keep making situations of buckets, but every situation has a thing it's solving. Every dollar has a thing that it's solving for. And that could be savings, that could be investments, and that could be just trying to get your cash flow expansion up. And so that's how I explain the bucket strategy. And then we can go into, kind of more the investment round. When we have people who are cash flowing their investments pretty well, then we start to open up a conversation on investments, because that's mostly what everybody likes to get to is, how do I invest? What do I invest in? What do I put it in?
Right.
And I'm like, well, sometimes you got to take care of home before you can grow the crop. So let's not worry about growing the crop. Let's take care of home and just pay down debt and put money aside for a period of time.
Yep. Because at the end of the day, I mean, let's talk about the interest rates that you might be having on your debt. Because at the end of the day, historically, the market has averaged around 10% since inception. We can all look at studies for that. But if your credit card's hashing away at 27% interest, if your car payment's hashing away at, I've seen some horrendous car interest rates where 12, 15%.
Yeah.
Let's look at that first.
Yeah.
At the end of the day, I'm going to use a big word here, folks, but maybe you can use it in your future conversations. That arbitrage, the difference between what you could be making in the market to what you're actually losing in interest. At the end of the day, if you were to put $10 into the market and then $10 to your interest payment, the $15 interest payment is going to be it's going to eat away at your wallet, eat away at your dollars faster than the money's going to grow in the investment account.
Yeah, I'll give a personal example on that, because that's exactly what people want to do is, where should I put my dollars? Well, I'm tired of looking at the car payment. My wife has a very little amount of student loans left, but no matter how much we pay on the student loans monthly, it doesn't go away. So if I put chunks of money at it and pay it off, I get my $300 something freed up of cash flow every month. I can put that money in the market, but if I do it at the right time, the right cadence, and the right strategy, I'm not really offsetting the growth in the market by that much. The interest rate on those is somewhere between 4 and 6% between the car or the student loans. The market's doing 12%, so I'm giving up 6%. Well, I'm not really monetarily changed in life by 6% this year. And so if I'm trying to pay off one of those line items this year, let's say I'm just going to knock it out this year and I'm putting chunks away to it, then next year I'm going to have that 300 freed up, or whatever that payment is. I can roll that onto the next line of debt that I have, which I would probably do. And that next year I'd be chunking away money to kill it. So in 2 years I would pay off all this debt and have $600 for the foreseeable future, for the next 5 years to put away. Instead of scrounging around and saying, well, I'll just pay those for the next 4 years on each of them, you could go ahead and accelerate that and move forward. And that's where people arbitrage. They try and figure out where's the most money made by putting it one place over the other. And at the end of the day, if we're splitting hairs, I'm not going to lose stress over that. Okay, I'm not going to sit here and split hairs. I want to put money to work consistently each month. I want to do that for my debt. I want to do that for my cash flow, and then I'm good. And then beyond that, it will take care of itself. And if you found $10,000 on the ground, you go, where do I put this? What's my goals? Where do I go with it? And then I make that arbitrage discussion. But in the meantime, set it and forget the cash flow and pay it off and invest it in the way you want to, and then chunk the money at it if you want to get it killed early. That's what I tell people.
Man, I wonder what would be the best way to answer my questions with that. It would probably be with a financial plan.
It's almost like you're seeing it now.
I'm putting the pieces together.
You're figuring it. He's a smart one, folks. I tell you. He is though. I say that jokingly, but he is. He is.
Yeah.
Well, we've talked a lot. Talk to me about. Okay, so we've talked about the buckets a little bit, where you put money. We've talked about tax buckets and how they work a little different, and then we've talked about cash flow. What I just did on arbitraging a little bit. So let's just jump. People want to hear this. So I think for this section, the rest of this section, and the next series, the next section we talk about today, we can jump into a little bit of the market outlook, but we can also jump into investments. Let's just talk spitball investments. What do people typically look for? What do you think?
I think that's a great idea. I think let's get to the meat and juicy bones of it. Because at the end of the day, if you're sticking around to this point, you want to stick around for this next part. Because talking about some of ProVest models, ooh, I like what we're cooking up here. All right, if you've stuck around to this point, we're going to talk about some investment stuff. Now, this is where we get a little bit more into the nitty gritty about what ProVest is doing with their investment model. So let's talk a little bit about that, Peyton. I know a lot of people will never they listen to their financial advisor. They want to hear, well, what are you going to make me? What's the returns are going to be? Which is a fair thing to ask. You don't want a financial advisor that's losing you 5% a year. So
well, here's the deal. This is the statement I think we all need to operate off of is our job as advisors is to help you grow wealth and steward it well. And we can show study after study how that actually comes true, and there's people who have studied it. But the statement I want to say is we don't necessarily make you rich. We keep you rich. So if you come in with wealth, we want to help you steward that, or you have obtained it through your cash flow into your 401k, or you've built a business and you have wealth that you have created. And you say, okay, now beyond this, I don't know how to handle it because I'm getting to a point where I need somebody to step in. That's where we want to float. Now, when it comes to investments, I'll give you some of the playbook. It's perfectly fine for you to hear it. The deal is we want, if you have diversity, it can maintain wealth well. Okay, if you do it right. If you have concentration, it can grow wealth well. Again, you have to do it.
Warren Buffett.
It's almost like he said it. And so it keeps you kind of in check with how you manage money. You can't have, $1 million in 10 positions unless you want to, but typically that's not how we do things because you do not know which one of those positions is going to lag or pull back 20%, or what if they all pull back 10%, right? So it's just too much risk, too concentrated. But however, what we like to do is create a baseline of ETFs of different models, and there's different ways to structure this. So there's not one size fits all, but there's different ways where we get you exposed to different parts of the different sectors of the market through ETFs. I'm not going to lie, we use ETFs. They're a good product to use, or a good investment vehicle to use. But beyond that, for our folks who really want to get aggressive, we put in a different model. We have several models. One of them we've talked about openly is called deep value. Now, we're not going to get into performance because that's not necessarily what this conversation is about, but it's a talk about how to look at investments. Once you have figured out, I've created a baseline, I've created diversity with these ETFs and structure it in a way that fits for my situation, my risk tolerance, my age, my goals, my milestones. That goes right in line with a financial plan. We know where you need to be in 5 or 10 years, so we know how to invest your money for the next 5 or 10 years. And so if we're doing that, then when we want to get aggressive with a piece of this money or a large chunk of this money, just depending again on each situation, we look for wonderful companies at a good price that we can understand, that have a compelling story, either a turnaround story or a compelling business model that they're going to capture. And then we would look to evaluate that company if it has a great ability to appreciate based on a few other metrics, but one of those being great leadership.
Yeah, and great leadership is something that we really look at, and not just in regards to the companies that we're looking at, but the overarching philosophy that we have with investing. I mean, let's take a look at, I know you read this a lot, but I used to read Warren Buffett since I was little. It took me a while to get the philosophies down because while I understood that cash flowing into investments, looking at companies, making a few smart decisions can really compound your wealth. At the end of the day, it takes time to learn that you want to be going against the grain for a lot of the market. Because at the end of the day, and this is shown over and over and over again, Wall Street is the only place where a fire sale could be going on and things are getting at a massive discount. Companies really haven't changed as much as their fundamentals, but they'll be trading at half the price. But that's the one time where people start running away, not buying, selling.
That's right.
But we're looking at those opportunities as this is a playbook. This is a standard playbook play.
That's right. So, I'll give you one that's already come to pass. And so I think it's okay to talk about one that fell in the purview of this deep value understanding of this company is out of favor, but they have an ability to appreciate. One for us was Intel. Now, this has again since come to pass, but the story was they had a great leader. He was not the sexiest in the world as far as like in his showmanship. He was very humble. But about 24 months ago, nobody was talking about AI stocks like they are now. Nobody was talking about tech and the AI bubble and I'm not going to call it a bubble, but the AI trade as it is now. But Intel was one of those that came across the desk for me. And I said, now this is worth looking at. This is a company that's been around for decades and has done exceptionally well and has always performed. What's going on? Well, sometimes when things fall out of favor, there could be a legitimate reason for that. And so when you have a leader come in, a CEO come in and say, hey, we're going to turn this back to focus on what we actually got into this for, which was building tech, some chips, computers, processors, then okay, you got my attention. You're going back to basics. It's what got you on the map in the first place.
Mm-hmm.
So that was one for starters. For two, there were some connections that they were making behind the scenes. I mean, people knew about them, but they were making that were in the AI realm where they wanted to get in line stateside to start producing chips. There was nobody stateside producing chips, and we just went through COVID. Everybody knows that if South Korea, Taiwan shut down, we didn't have anything coming out of there for tech, and that was a problem. And so, lo and behold, the government put in a bid. NVIDIA put in a bid to back Intel as the big boys to be stateside and help create some new chips. They did that. They had a new CEO change because the board got antsy because it wasn't performing as fast as they want.
Mm-hmm.
So that was unfortunate, but the CEO they put in there was still a really good one, so that kind of fit. But they had good cash flow the whole time. They weren't falling apart. It was 19, 18, $20 a share. I mean, it was dirt cheap compared to where it had been. And they had a sustainable model. We know what they do. Everybody knows they produce tech and they produce chips and processors. And so all of these things that we're talking about just started to fall into line. Good cash flow, low debt. We understand what they do. And they're not going outside their skis anymore. They want to stay within their realm. And so that's the type of investment we like when we look at individual stocks. It can be tough, but when we look for catalyst and we look for something that is attractive to us and has a long-term future of success. That's what we believe in. And so we bought into that early. My clients did. And that has been fruitful. But at the end of the day, like we were early. We sat on it for almost a year, and it was just kind of doing nothing. And then it started growing. Then it started taking off. And then the news pieces came out about the bids from the government and NVIDIA. So the point is, are we going to do that with every single client? No, not necessarily. But we start with the basics, which is the ETFs I described earlier, getting the foundations right. And if it makes sense for you to do a dividend model or a deep value model or just a core growth model that we have, that's fine. We can do that. But there's sometimes when we're underwriting these companies, we take an opportunity to go a little deeper and see if these have a great opportunity ahead of them.
Mm-hmm.
And in Intel's situation, it did, and it worked out just fine. And they're thriving, and they're going to continue to do well. But the point I'm making is, Gabe, when people go from the financial plan to investments, they do want something like that. They do want to know, like, okay, if I put my money to work, where else can we put it once we put it in that account? What are the options? That's
Right.
where we probably spend 70% of our time on what I just described. We spend 30 or 40% of our time talking about investments and planning and taxes and all that. And then when we actually put it to, rubber meets the road, then we jump off into the investment conversation and kind of we get to put on that hat that I just kind of laid out for you.
Right. And let's touch back on, you mentioned while deep value might work for some people it might not. And that circles back to risk. Risk profile is a major thing that we look at to make sure that people are comfortable with what they're invested in and where they're going to be going in the future. Because at the end of the day, if you're comfortable with where your money's at and you don't want it to go anywhere, we can plan for that. But if you want it to grow and you have a comfortable nest egg, we can put a allocation to that we would see as appropriate. We'd want your approval on it. But let's figure out what would be a good way to have a portion of your money grow to keep up with inflation while having the rest of it. What's the word I'm looking for?
Well, diversified,
Yeah.
managed, spread out. I mean, you don't want something that's got 150 positions. Mercy, that would be too much to manage. So part of it is a balance between simplicity and the management style, and the other piece of it is folks that I have clients, my grandparents' age, they're in their 60s, 70s, 80s range. They want a little exposure to some of that growth I talked about, but they want those dividends and those consistencies. I mean, we have to be able to work with all sides of that risk tolerance scale.
Mm.
And the way I explain it to you is how we look at underwriting a company as a whole. When we really think that they're out of value, there's some other metrics we look for, but that's the main focus. A company producing a dividend is really great for a lot of people who are in retirement, produce some income. It also is fairly consistent. It's not as volatile. And so we look for those types of investments as well. Still, good leadership, good future. They're focused on their skis and nobody else's. Good cash flow, low debt, no risk that they're involved in, depending on the sector. And we go from there. I mean, I've got some great REITs that I've run across that I love, and there's a timber REIT, there's a global REIT, there's a low. So sure, we can sit here and talk all that stuff. My point is, folks, if you're listening to me, there's a rhythm and a rhyme for everything that you do with your money. And then when it comes to investments, it should be no question that what you put together for yourself, or an advisor as a whole here at ProVest, we know we can do this, that we are making sure we're putting what your interests are ahead of ours, and that we're making sure that it achieves what your goals are and your milestones are, whether it's the planning piece or the investment piece. But it's got to fit what you're looking for, and we can create something to fit what our clients are asking.
Fantastic. Well, let's talk a little bit about, while we talked about our research in for some of the investments, the research is one part, but the market outlook might be another. What is the economy doing that might affect these companies? Let's talk a little bit about what's going on in the broader economy. Let's talk a little bit about what's going on in the economy and how we see things, because I know that,
Yep.
man, predictions are a dime a dozen, and we're not going to be predicting anything, but let's just call it how we see it, because at the end of the day, people might not understand people don't know what they don't know.
Well, let me tell you what averages are, and then we can talk about where we're at. The market's up around 13%, give or take, depending on the day, with tech bouncing around.
Mm-hmm.
But as of August of 2026, we are somewhere in a close average where we're above the average trend when it comes to return for a midterm year. People keep forgetting that. They talk a lot about the war, which had a lot of volatility in it. But beyond that, a midterm election year typically returns 6.2%, okay, based on the data. And that's going back, I think, to the 50s. It might be the 30s. But the point that I'm making is, if we're above or below average, that's fine. Doesn't matter. We don't have to even get there. We don't have to go down to 6%. That's why they call it an average. But when we're looking at the rest of the year, I would tell you, you potentially could expect between August and November a pullback in the market. That doesn't mean you need to run for the hills. That doesn't mean that's a prediction. The average on the chart, if you lay it out, extrapolate it out, looks like that. That's how it plays. We have a pull up in August and September, and at some point it pulls back pretty hard. Like we have a run up, right? And then we pull back. So that from a stock market perspective, that's what we're talking about. The economy as a whole, they thought it might grow at 5% this year, and it's looking like it's not going to. Pretty sure it's not going to. We're already halfway through it. And so it's going to be somewhere between that, I think, 2%, 3.5% number of GDP growth. So that's a good number. We're positive in growth. And then beyond that, when it comes to things humming and growing, we get earnings report from companies, which is a reflection of the economy, a reflection of how they're doing, and earnings are expanding. I think the number I last saw, I think it's above 72%, but 72% of the companies reporting earnings in the S&P 500 had expanding or had beaten their estimates. And so that's a good sign. Now, what I'm not saying is things are going to go terrible if the market rolls over. I'm not saying things are going to go terrible next year or are not going to go terrible. I'm just simply saying what has happened and what the average return in the stock market has been. But as far as inflation is concerned, it has held steady this month. They just reported yesterday. It did not increase. It didn't have a big jump. And the Fed's looking to potentially raise rates, but not cut them. We projected this year to cut 2 or 3 times, and now we're at a standstill with a potential to raise one coming up in September. We'll see. The job claim, as it comes out, jobless claims, how are we firing people, hiring people, seems to be a little bit shaky. I think that's the biggest part. But inflation has been a little sticky where it's not coming down. So we can't have inflation go up, and we can't have people out of jobs and they cut interest rates. More than likely they're going to hold. They could raise. And I don't know if that's necessarily going to be the catalyst for this average pullback that we see in a midterm election year that I described earlier. I don't know what the catalyst is, but that could be. Now, I'm preaching a lot of different verbiage there. Okay. If you don't understand it, let me put it this way. Gabe, if you're investing, you should continue to invest. Gabe, if you're worried about the economy, you shouldn't worry about the economy, because worrying is not going to get you financially free. Mm-hmm. And investing consistently each month will build wealth over time. And that's the message I want you to hear. All the other stuff I said is a little bit of noise, but it's the truth of what's going on and what averages are. So manage your expectations accordingly, that you don't have an expectation that we go to 25% in the stock market this year in return. We could. Average says it's 6.2. So manage your expectations accordingly and go from there.
I remember at the beginning of the year, it was JP Morgan and I believe it was Bank of America. They were calling that 2026 is going to be a massive hit. Like just the first half of the year, they were predicting that we would see negative growth. AI was going to start slowing down. I remember seeing very bearish analysts about the beginning of the year. And so far, here we're at now. things can change, obviously.
Absolutely.
We're keeping up to date on that daily, but where we're at now is not at all what people were preaching 6 months ago. So it's always good to keep on your toes, and this industry is about keeping on our toes, getting ready to shift if things need to shift. But I think you hit the nail on the head with invest consistently. Listen, time in the market beats timing the market, because if
There
you
you go.
try to time the market, anybody who's on a device right now or near a device, look at the S&P 500 chart. Just look at where that has gone the past 50, 100 years. Look at the overall direction. Now, if you zoom in, it's a little harder to figure out what time you would want to buy in, because it's hard to time the market. You can't know you can't know what you don't know. Tomorrow tomorrow a satellite could hit Tesla's factory in Texas, and God knows what will happen to that stock if that happens.
That's right.
So if
Stay
you're going to
invested.
play it safe, stay invested. Keep investing. Buy if you're looking at a good dip opportunity. If you see a good dip, buy the dip. It's a good opportunity to dollar cost average at the end of the day, and that's going to be the overall best option for most people.
If you're having questions about your financial picture, we're happy to take your phone call at ProVest. You can visit us at ProVestWealth.com. You can reach out to us. You can reach out to me directly at Peyton at ProVestWealth.com. Peyton is with an E, by the way, Peyton. Or you reach Gabe at ProVest Wealth. No, I'm sorry, Gabriel at ProVestWealth.com.
I wish it was good.
That's right. At the end of the day, we want you to stay invested. We want to do what's best for you, you to do what's best for you. And if we can be a part of that process and help build success with you, we would love to do it. We work with all kinds of busy families who want to simplify their finances, demystify what's going on in the world, and just get it straight from the sources, fast as possible, so we can make sure that we're making the best decision for your finances and your family. But remember, the price of oil, inflation, the headlines in the market do not determine if you sit it down at night, spend time with your family, and enjoy a meal with them. That's what we're all trying to chase. We're trying to enjoy the time we have here on earth and what God's given us. And here at ProVest, we want to make sure you can do that as simple as possible.
Mm-hmm. You know what? I'm going to really mean it this time. I don't think I could have said that better.
All right, Gabe, so let's talk.
Well, Peyton, you touched on the conservative bucket, the moderate bucket, and the aggressive bucket. That's all great. I originally thought you were going to be talking about, and I think you'd be wise to talk about another 3-bucket strategy: the tax-deferred bucket, the tax-free bucket, and the taxable bucket. Now, what do I mean by that? Your dollars could be going into one of those 3 buckets, and all 3 buckets serve a different purpose. Let's give some context on each bucket and what might those uses be for people. Because at the end of the day, they hear 401k, they hear a Roth, they hear an IRA or a brokerage account or a joint account. But what does that mean?
Yep.
What kind of impact does that have on me as an individual? 435B. I don't think I said that right.
457.
457.
43B. Okay.
Numbers in this industry.
There's a bunch of numbers. The 3 buckets that we put together for taxes. Here's the deal. Folks that are in their late 50s, 60s, and 70s typically focused on one bucket, which was pre-tax. In the past 20 years, you've had people, and that's when the Roth came about, you've had people focus on pre-tax, which is your 401k. Think of it that way, or a traditional IRA. And they talked about a Roth, which is post-tax money. You pay tax on it, and you put the money in there. It's never taxed again. I'm going to break this down here in a minute. And then what we're finding in this generation, or the new last 2 or 3 generations, have been focusing on realizing they need to focus on the brokerage account or the post-tax bucket that is not tax-free when you sell it. Okay, let me explain all that. If you make $100,000, just use round numbers here. Stick with me, folks. You make $100,000, you put $10,000 in a traditional IRA or a 401k. Let's ignore the limits for traditional IRA for just a minute. Mm-hmm. You would then be taxed at $90,000 because the government says you put that money in pre-tax. We're not going to tax you on it, so we're not going to count it against you this year for your income. You've now got $10,000 in a 401k or a traditional IRA that you put in there, and you now pay tax on $90,000. Okay, so you could lower a tax bracket depending on if you're joint filing, or if you're a joint household filing together, separate, or a single filer. That all matters. But the point is, they just credit that money into a 401k and say you don't have to pay tax on it. So you're lowering your tax bill. The Roth IRA, if you make $100,000, you get taxed on $100,000, and then you don't put it into 401k. You put money into a Roth IRA, or you put money into a Roth 401k. That money you are taxed at $100,000. Let's say you have $85,000 left over after taxes, and then you put $10,000 in. Now you take home $75,000, and so you're going to pay tax now On those dollars, whatever you have left over, if you have surplus, you put it into the Roth equivalent, and that money is never taxed again. So Roth is tax-free in the future when you withdraw it. The pre-tax money you put into your 401k or your traditional IRA or rolled it into a traditional IRA when you retire, when you pull it out, it's taxable. So it's in a taxable bucket. So it's pre-taxed when you put it in, but once you take it out, now you got to pay tax on it. The post-tax bucket is putting money into the Roth IRA after you pay tax on it, which then becomes tax-free when you withdraw it in retirement or when you withdraw it in the future.
Because I think the age limit to start withdrawing that is 59 and a half.
So you have to have it for 5 years to do there's certain things you can do with your Roth prior to 59 and a half, first-time home buyers. There's some other things you can do.
Right.
But yes, by and large, most of the retirement accounts are made so you don't withdraw it until 59 and a half and to avoid the penalty.
Now, let's talk about that. It's a perfect segue into the taxable bucket.
There we go.
If we need money before 59 and a half, where's the accounts that we might do that in?
That's the problem. People have been funding $2-3 million into over 30 years into their 401k, and they pull it out and they say, I got 50 grand in cash and I got to retire. And well, sometimes in retirement, you got to buy a car. Well, I don't want to spend 40 grand on a car, and I need another 40 grand to live off of, and I got to draw 80 grand this year. Well, that puts you in a different tax bracket. So the brokerage account, if you make all your money, pay tax, and you put money in a brokerage account, you could have a tax problem down the road if you put all of it. But what we're suggesting people do is look at the match at the 401k. Again, it's different for everybody, but get the match at the 401k level, at your company level. Look at the Roth IRA and what that looks like if you want to put money there, because that's tax-free money in the retirement. Okay, think big picture. But in between now and then, if you fund a brokerage account, at some point in the near future, you're going to need to buy a car, or your AC is going to go out, or you're going to need to pull money out to pay for a wedding for your daughter. Okay, I got a daughter, so I know that's coming. I'm preparing. She's 6, almost 6, so we're socking it away now. We're going to tell us a much lower budget, but hey, we're going to have preparation for it. So that brokerage account becomes a flexible slush fund, really, at the end of the day, of however you want to spend it. And so I'm having clients heavily fund those because we're just seeing more and more that people need money. Mom and dad go into a home, they don't have any money readily available. I can write a check, pay myself back out of it. Why don't I take it out of my brokerage and I can do that? And it gives you flexibility, pay for college a little bit, buy a car for the kid. And so everybody's got a different time for that. Everybody's got a different strategy for that. And then, we put that money in the brokerage, invest it in the market, and grow. So you may not need it for 5 or 7 years, but you can't touch the 401k or Roth money without paying a penalty, at least 10%, if not more, depending on taxes. So we put it in this bucket. We can control that with 0%, 15%, or 20% long-term capital gains if we held it a year. So it gives you this midway between your checking account, which is getting eaten by inflation if you just leave it sitting and checking your savings, and the retirement account that if you leave it in there, you get eaten alive with fees and taxes if you take it out. So the middle ground is control it. And so I'd rather have control of my finances. So we create. So that's the 3 buckets. It's pre-tax bucket and you pay tax later. It's post-tax bucket and then you never pay tax again in the Roth example. Or it's the brokerage bucket, which is post-tax. You pay tax on the money. And if you can cash flow money into it, you put money into it, then you can control what you pay, when you pay, how you pay, if you buy or sell. And that creates taxes, or it doesn't. And then you can live off maybe some dividends if you built it up. I know guys who have a bunch of money in a brokerage account, and they live off some of the dividends while they're retired early, while their retirement accounts are still growing. So it gives you flexibility to retire early, pull money out, buy into a business. And so that's what the 3 bucket strategies are, or 3 tax buckets are. And that's how a brokerage account fits into that and can solve problems.
Yeah. And I love the 3 bucket strategy because we get, as advisors, we can play around with the 3 bucket strategy depending on the individual situation. We all know that maybe somebody who's 30 years old, they are making, let's make it $600,000 a year. While they can fund the 401k as much as they can, where's that rest going to go? Well, we can look at some Roth options. We can look at brokerage options to reduce taxes. But if we play around with it, the best way that we can build a financial plan for that would be, let's see what would affect your tax bill the least and grow your assets the fastest. When it comes to an older individual, Roth is a really big thing. They're nearing their time of retirement. They might teeter off into their working years. Their income might be reduced whenever they retire. That's a golden opportunity to start having a conversation with Roth conversions. Let's take some of that 401k money and move it to Roth so where it's not taxed again. That's not a blanket statement that everybody should do it, because at the end of the day, if we are going to be converting to Roth, we want to make sure that because if we do start to convert 401k to Roth money, you're going to be paying taxes on the amount that you're moving over.
That's
so if we do have to pay those taxes, will the money grow past what you paid in taxes to warrant that conversion? And that's a big question we want to answer for a lot of people whenever they say, you know what, well, I want to do some Roth conversions, but what is that going to cost me at the end of the day? And so that's a fun thing that we get to play around with the 3 bucket strategy.
That's right. We just want to build it out, let everybody have their situation that's different, and we build it out accordingly, and then we can pull and push from it later.
Mm-hmm. Peyton, this was a good little show, folks. Thank you so much for tuning in to the ProVest Perspective. I'm Gabriel Lopez, and sitting with me was Peyton Hoppus. Peyton, at the end of the day, how would you summarize this whole episode today, if you were to summarize it?
Well, we've talked about financial planning. We've talked about underwriting or looking at tax buckets and understanding what those do for you. And then we've talked about investments and how we look at those. So I think a good summary is if you fail to plan, then you plan to fail. And if you don't know where your money's going, you don't know how it's being invested or how to put it in the right spots to solve a problem for you, you don't know what you don't know, then you're going to have a problem.
And if you need help with that, we are always willing to have that conversation. Even if it's just a market conversation, we love to have some of those conversations as well. Feel free to call us at 864-582-7766 or visit us on ProVestWealth.com. We would love to see y'all there. Feel free to check out all the free blogs, newsletters, YouTube videos we have on there. We make tons of exciting content that we want to push out to everybody as often as we can. Well, it was fun, Peyton. And until next time, don't just invest, ProVest.
Y'all stay frosty.